All right, let's get started. So, hello everybody. My name is Jason Malabute. I'm the founder of Malabute and Company CPAs. I've been doing tax and accounting since 2013. I've been a CPA since 2015, and I'm also a real estate investor. I've invested in single-family homes, multi-family properties, and also I've invested out of state. That's why our firm specializes in working with real estate investors and real estate professionals. Okay, let's get started. So today we are going to talk about something very exciting, something that a lot of people are interested in, which is refunds. All right. So 2026 refund surge. They said that 2026 you will see the largest refunds in recent history. Okay, so we're going to be talking about why that is. So, a couple of things going on here. Okay, so there's a few things that we need to cover. So, first thing is that a lot of major outlets are saying that 2026 are going to have higher refunds than average. In fact, experts are saying that refunds are roughly going to be about $1,000 higher than normal due to multiple factors, which we will be discussing shortly. Also, refunds could increase 15 to 30% compared to previous years, which will add roughly $50 billion to total refunds issued nationwide this year. So last year in 2025, the average refund was about $2,939. And those refunds could be as high as 30% higher this year. So here on the right side of your screen, you can see the average refunds by year. So remember that 2023 taxes were due in 2024, 2024 taxes were due in 2025, and of course 2025 is due this year. So I didn't want you guys to get confused by that chart. Okay. So as you can see in 2024, the average refund was about $3,050, and this year it's estimated to jump up by $750. Okay, so why is that? Why are we seeing big refunds this year? Is it because of the tax law? Well, that's only part of the reason why. Here are a few of the other reasons why we are seeing bigger refunds than usual this year. Okay, so the first thing is that remember back in July of 2025, the one big beautiful bill was passed, and that tax bill had sweeping tax law changes. So that is a big factor. But a bigger factor on why we're seeing bigger refunds this year is because of the withholdings, right? The withholdings tables were not updated last year to match the tax law changes. So then therefore what happened was you had millions of workers essentially overpaying in taxes, which is what withholding is. So that's going to result into bigger refunds in 2026. Okay, so there is a matching issue when it comes to withholdings, and there's also a timing issue also when it comes to the refunds getting paid out this year in 2026. So those are the three major reasons why we are seeing bigger refunds this year. So one is the new tax law changes last year. Number two is the mismatch in withholdings. Basically, employers were withholding more last year because of their withholding tables not being updated. And number three is the timing. Okay, so those are the three reasons why we're seeing big refunds in 2026. Okay, so let's go into more of the details here. So remember that tax cuts were applied to 2025 income, but payroll withholdings largely continued under old higher tax rules. So that's a big impact there. And number two is that employers withheld taxes as if the new tax laws did not change. So remember that when you're working for a company, the company withholds federal and state payroll taxes. So that's what they are talking about there. And also from a timing perspective, the IRS will reconcile this mismatch when 2025 taxes are filed, which will trigger high refunds, which we discussed that in the previous slide. Okay, so remember that this is a temporary thing. Do not expect your refunds to continue to be this high. moving forward to future years. Alright, so this table here, you can see the 2025 withholding table. So as you can see there, you can see the income bracket there about how much are they withholding from your paycheck based on how much income you make every year. And then also another factor to that is what is your filing status? Are you filing single, married filing separate, married filing joint, or head of household? So all that matters. So make sure that you talk to your accountant about are you using the right filing status? Because that could really affect your taxes. For example, we have clients coming to us who just got married. They ask us, should we file married filing separate or should we file married filing joint? And to make that long story short, there's very minimal advantages to filing separately. And one of those things is tax brackets and not tax rates, but that's a conversation for another day. Okay, so this is kind of goes over what we were talking about before about the refund that largely resulted from millions of W-2 workers basically paying more in withholdings in 2025 that didn't really match the new tax laws that passed last year. So what are the big changes in the tax laws last year? So here are just a few. There's way more than this, but here's just to highlight a few, okay? Standard deduction increase to 15,750 per single, 31,500 per married filing joint. Okay, now you could deduct up to $40,000 of SALT. What does SALT stand for? State and local taxes. So that includes DMV fees, property tax fees, that all goes to SALT. So for the next few years, you could deduct up to $40,000 before it goes back to $10,000. Okay. Also, no tax on tips. Remember that. That was a big campaign promise by President Trump. But of course, there's a catch to everything. There's certain income levels that you need to meet for you to qualify for no tax on tips. Also, auto loan interest, we're going to be talking about that more. You can now deduct auto loan interest and you don't have to be a business to do so. So that's pretty cool. So another thing that's big for real estate investors is 100% bonus depreciation. We're seeing a lot of our clients use the 100% bonus depreciation coupled up with a short-term rental loophole, which you're only required to meet 100 hours per year for a short-term rental versus for real estate professional for long-term rentals, it's way more hours in regards to criteria. 750 total hours dedicated to real estate, 51% of your total hours must be dedicated to real estate, and 500 hours of material participation towards your own portfolio. Okay, so those are just some quick facts for you. Okay, and then also child tax credit increased from 2,000 to $2,200. Okay, senior deduction. This is temporary. They get $6,000 of additional exemptions. Okay, and no tax on overtime. Again, there's limitations to that. Okay, opportunity zones are back, but now they're focusing on opportunity zones in rural areas now. So that's very important to know. Okay, manufacturing buildings, more specifically qualified manufacturing buildings, you can deduct 100% of the cost in year one. So that's pretty good for people who are in manufacturing. Of course, you need to meet a certain requirement for that for you to benefit from that tax benefit. There's way more. Some of the things that were not on that slide is you have the Trump accounts, you have the QBI deductions, there's so much more. Okay, so here it is. We already talked about it before. You can see how much standard deduction increased from the Tax Cuts and Jobs Act versus the One Big Beautiful Bill. You will see the jump in standard deductions across the board from single to head of a household, married, filing joint. Okay, so you will see all that in this chart. Okay, tax credit, as I mentioned, it went from 2,000 to 2,200. Part of it is refundable. And also, there's certain thresholds, again, that you need to meet for you to qualify for that tax credit. Okay? And this is what I was talking about before. Enjoy the $40,000 of SALT deduction cap, which increased to $40,000 from 2025 to 2028. And then after that, it goes back to $10,000 if the government does not do anything to bring it back after 2028. And then we already talked about this, the personal exemption for seniors who are over the age of 65. They get a temporary exemption of $6,000. Okay, there are phase outs here once you start making $75,000. Okay, and that is just totally phased out once you make 175,000 single or 250,000 married filing joint. Okay. All right, we already talked about this. So no tax on dips, no tax on overtime. This is great because people who are in service business who get tips and people who work overtime who meet their qualifications can save more money in their pockets. Okay, so I put here all of the phase out rules for these tax benefits, so you could read that there. All right, okay, what do we have here is the auto interest deduction. So remember, you guys, there's certain rules here. So you can deduct up to $10,000 of qualified auto interest, but the loan has to begin after December 31st, 2024. The vehicle must be made here in America. And also, it cannot be any commercial vehicles or anything that you lease or fleet sales, and also cash out refinance does not count here. Okay. And then also KPI deduction. Okay, so it is it. So KPI deduction, if you are a sole proprietorship, partnership, S corps, you can get KPI deduction. What is KPI deduction? You can deduct up to 20% of your qualified business income. So there are limitations if you are a certain kind of business, like an SSDB, then there are limitations to your KPI deductions. Okay. So now in 2026, entity classification strategies is even more important. Because remember, you guys, if you are a Schedule C, that means you are a sole proprietorship, or if you are an LLC and you have an active business, all your profits is subject to self-employment tax, which is about 15.3%. So that's why it's even more important now to talk to your accountant about, does it make sense for you to change legal entities, whether it's a S corp, a C corp, to lower your payroll taxes? Okay, so make sure that you are paying attention to that and talk to your accountant about that. Okay, and then as usual, if you are a real estate investor or a business owner, it's important to plan out your upgrades, right? Because repairs and maintenance is deductible in the current year. Capital improvements need to be depreciated. So, meaning that planning out whether you're going to invest in capital improvements can be a strategic decision, especially once you start playing with depreciation expenses, right? Because remember, when you do repairs, you get expenses in the current year, but when it comes to capital improvement, that is capitalized over multiple years, not unless you do cost segregation and bonus depreciation, where you can deduct the entire thing in the first year. So that's why it's important to talk to your accountant about the investments that you're planning to make in your business, in your real estate portfolio, so that you guys can strategically plan for depreciation. Okay. And then we've talked about this. This is one of the biggest things that real estate investors are excited about is the bonus depreciation coming back. So when you use that with a real estate professional or the short-term rental loophole in certain cases, some clients are able to offset a major chunk of their active income with what would normally be passive losses. So we're certainly seeing a factor there when it comes to clients lowering their tax liability or increasing their refunds. Again, as mentioned before, strategic planning when it comes to key investments. And once I replace the roof of my building, if I'm a gym owner, should I replace all of my fitness equipment this year, or should I strategically replace key equipment every year so that every year I can enjoy depreciation? So those are conversations that you need to be having with your accountant. So real estate specific tax benefits. All right, so qualified opportunity zones, I mentioned this before, they are now focusing more on rural areas when it comes to qualified opportunity zones. So what are qualified opportunity zones and how does it benefit you? So you're able to defer capital gains if you keep your investment in the opportunity zone for a certain amount of time. Okay. And then you can also enjoy, reduction of gains, tax-free growth. Again, as long as you keep the capital in the investment for 5, 7, or 10 years. Okay. Again, I talked about this real estate professional status. You're able to offset active income from your W-2 wages and also your business income with passive losses. Normally, passive losses can only offset passive income. But with a real estate professional status, you're able to offset your active income with your passive losses. So maybe talk to your accountant. Is it worth your spouse to quit their day job and become a full-time real estate professional so that both of you guys can enjoy offsetting your active income with your passive losses, right? So there's a lot of planning when it comes to qualifying as a real estate professional. Again, real estate professional and short-term rental loophole, those are things that you need to qualify for every year. So just because you qualify for those things this year doesn't mean that you'll qualify for them again next year. 1031 exchanges, this must be the most popular tax strategy out there. So once again, 1031, you're able to defer your capital gains. You're also able to defer depreciation recapture. A lot of people don't know that, but you are taxed on 25% rate on depreciation that you have enjoyed in previous years. So when you do a 1031, you're able to defer the capital gains and also the depreciation recapture. And then if you keep on doing it in 31 until you pass away, you're able to typically avoid the capital gains tax because when you pass away, your family members, your loved ones who inherit the property get a step up in basis, which will eliminate all of the capital gains. All right, let's go on. More tax strategies, okay, that you need to be aware of if you want to maximize your refunds. Okay, so here's any question. Okay, so what do you do if whether you have done tax planning in 2025 in preparation of this year, or what if you totally missed the boat in 2025 and that you're just trying to salvage as much tax savings as you can for this year. So there's a few things that you need to do. Okay, first thing is you need to document. Okay, like make sure that all of your receipts are properly documented. Make sure that your bookkeeping and accounting is up to date. Okay, all those things are going to help your CPA, your tax professional, making sure that they can maximize your tax deductions for 2025. Okay, so again, it's very common. I see this all the time. People want to file their taxes by the April 15th deadline, and I always challenge my clients to take advantage of the 6 months extension that the IRS gives you. Okay, you are not more likely to get audited when you take the 6 months extension, despite what people tell you that is a miss. Okay, and number two is when you take the extension, you are giving yourself more time to document and organize additional deductions that you might have missed if you rush the process and file your taxes as soon as possible in April. Okay. All right. So there we go. Does anybody have any questions? I know that we have some guests here, so I'm going to open up the chat. Let's see if I have any questions from Franklin or Cindy. Did you have any questions for me, Cindy? You or John? Did you have any questions for me?
Oh, well, I actually have one question. I put it in the chat, but
Okay.
it's like I wasn't sure, was Social Security part of the big beautiful bill? Is it going to be taxed in 2025 if you receive it, or did they stop the taxation and they're still deciding what to do?
So I have been following that. I know that depending on who you talk to, it seems like tax professionals interpret that rule differently based on who you talk to. But based on my understanding of it, Social Security is still taxed if you meet certain thresholds. But I will personally refresh my memory on that because I know that that one is not that clear. So I will definitely look into that one more.
No problem. It's like we just kind of like closed out our books with our prior bookkeeper. And so I'm getting ready to send some stuff over to you along with, our tax returns and all that stuff so you can take a look at it. So anyways, that's part of my income is I did start collecting my Social Security.
Social Security is normally taxable. However, with the new tax laws that got implemented last year, and some rules, some laws, even though they were came into law last year, last July, they are not implemented until this year. So that's why I was saying I will personally look into more of the Social Security because it's one of the things that we need to look into more to make sure that we understand has there been any new changes to that particular rule moving forward. So yeah. And Cindy, you brought up a very good point, something I've been meaning to tell you and also our other clients as well and people who are watching this webinar, which is unfortunately we're seeing way more cyber crime now than ever before. We're seeing an increase in identity theft. So I always tell people, especially people who are older clients, is try not to attach documents to any emails because those can easily be phished by bad people. So what your CPA will do, and I will do it for you as well, since they take it from running me, is they are supposed to be sending you a secure portal where you can upload all your documents.
Perfect. That's normally what I do. So
Yeah. Yeah.
yeah, is upload through a secured portal.
Yeah,
So
so I will do that for you, Cindy. I promise I'll get that to you this week. Okay?
perfect. And then we're ready to start uploading to you.
Excellent. Does anybody have any other questions here?
We also put together the wording for you on how our notes work and
Oh yeah.
stuff. So we're going to be sending that over to you too as well. We
Okay.
tried to put together a flow chart, but ChatGPT just didn't want to cooperate, so we ended up writing it out.
Uh, uh,
John did it. So we've got that all ready for you as well too.
And what about leasing your car?
Oh, he already, no, John had a question about leasing my car. So it's like, but you had mentioned that leasing is not written off and stuff. So I guess I just continue to track my business miles.
yeah, so I wanted to clarify on that. What I meant by that is you're able to deduct auto loan interest now up to $10,000. And it doesn't matter if it's for your personal car or your business car, you're able to do that. But what I'm saying is that if you are leasing your car, then you cannot deduct your auto loan interest. That's
Right.
what I was saying.
So, but I can continue to write off business
Yeah.
miles. Yeah.
Yeah.
Okay. All right. That's what I thought I heard you say.
Yeah. Okay. Any other questions before I let you guys go?
Anything, John?
I'm good.
John's good. I'm good.
All right, then, you guys, thank you very much. I will talk to you guys soon. And remember, you guys, if you need to follow your 1099s, you need to follow it by January 31st. Thank you very much. Have a great rest of your day. Thanks. Bye.
Thanks, Jason. Have a good night.
Good night. Bye.